Thank you very much, Trevor, and looking forward to spending the next 15 minutes with you and your clients this morning. So Trevor's given me the topic of questions to ask your manager, or at least your asset manager, regarding responsible investing. So I hope today gives you a bit of context to where responsible investment currently sits globally and in South Africa, and probably the right type of questions to ask your fund manager in terms of the work that they are doing in this space, as well as some bigger ideas for yourselves to take home and think about. So I thought a good place to start today would be a recent headline article from The Economist, where basically they were calling for the unbundling of ES and G, essentially to move the E or compartmentalize it in its own category and almost focusing purely on emissions. So calling for a bit of simplification of the acronym, which they term quite an ugly acronym in their words. But I think it's quite an oversimplified view and quite a northern view of ESG. I think in South Africa here we faced with quite a lot of context and complications that maybe our northern counterparts don't have. So I just took a couple of quotes from that article, which The Economist kind of recommended. And the first one being that climate change is too big a risk to the financial system to deal with under the old rules. And I think this is a fair statement. And we've seen the JSE, as well as international bourses as well, come out with different requirements from a climate disclosure perspective, which I think is a good thing. The second takeaway there was measure less but better. And I think, again, this is also a fair statement. And The Economist here, we're focusing more on CO2 emissions at a corporate level as almost the sole thing that asset managers should focus on in this space. I think it gives investors a lot of clarity in terms of how they look at their portfolios, as also how they engage with companies around their own CO2 emissions, what their targets are as we look to get to net zero by 2050. So I think that's also a fair statement they made. A couple of extra comments there on the right-hand side. Everywhere concerns about false marketing are growing. I think for those that have kept in touch with a lot of the news, particularly out of Europe and DWS or Deutsche Wealth Services, where we saw some legal and litigation action there on the back of potential greenwashing and mislabeling and mis-selling products. We also had quite a key figure, I think, head of their sustainable investing from BlackRock step aside from his role and also claim they were doing quite extensive greenwashing on their side as well. We think that regulation is a good thing, but it is a double-edged sword, and it can actually stimulate progress in ESG and responsible investing. And I'll try to touch on that a little bit later today. The second comment on the right-hand side there, that fees for managing ESG funds tend to be higher than for non-ESG funds. And the example they used in the article was, I think, a BlackRock fund, your normal index tracker charging around 3 basis points, and the ESG fund about 8 basis points. So about a 5 basis point greenium is the word that we use, a premium on the green investments, which I think any fund that is dynamic, moves away from the benchmark, requires a little bit more of human capital behind the strategy, will come with a higher cost. And I think that's to be expected. But I wouldn't make too much of a sweeping statement around ESG. I think you have to give a bit of local and global context, as well as the type of products, whether you are looking at active versus passive. And then the final comment on the right-hand side there, it's a myth that ESG funds outperform. You can't have it all. Probably the most controversial statement out of all of these five. No ESG fund is created equal, so it's very difficult to say whether ESG outperforms or not. In the next slide, I do have a chart that shows where the sentence is coming from and the meaning behind what they were trying to say. So just a bit of context to where ESG flows are, or at least how it's performing, if we can almost think about ESG as an asset class. So this is cumulative flows into equity funds over the course of the last 7 years, since 2015. So while your typical non-ESG or your traditional funds, as we refer to these equity funds, have seen significant outflows over this period of time to the tune of almost $3 billion, at least $3 trillion, I beg your pardon, worldwide. And ESG even bucked the trend during times of COVID, where they had inflows into the space. So on the top there, you just see total ESG. That'll be passive as well as active, and then just the active charting below that as well. So we believe that ESG is here to stay. It's not a fad. It's almost become a way of investing, and really embedded into the investment thesis and the way that fund managers manage money, for that matter. So the final statement on the last chart, the last page at least, that I mentioned around performance in ESG. This is investments funds excess return in dollars as a percentage. So in 2020, ESG funds in the dark green there outperformed the traditional non-ESG funds. In 2021, they also saw lower drawdowns than your typical non-ESG funds. However, 2022 has been an anomaly, an anomaly here. Let me keep it simple. In terms of ESG relative to the benchmark. I think a lot of description behind this relative weaker performance is probably the low exposure to fossil fuels, and the conflict in Ukraine, between Ukraine and Russia, at least, has obviously seen heightened coal and oil prices, and that's probably reflected a lot in these ESG style strategies that exclude a lot of what would be considered your typical sin stocks. So where are these trillions of dollars going into? The systematic rank by USD billion into certain investment style themes at the top there, and obviously quite overwhelmingly receiving the bulk of the assets, is the energy transition. Very prevalent here to South Africa as we move away from a heavy fossil fuel relying grid system to something a little bit more diversified, a little bit more space for wind and solar. And this came through strongly actually in our fund manager review last year as probably the core theme that they're seeing opportunity as well as risk in the ESG space, as well as resource management, the digital economy. You also see AI there, life sciences, demographic and future mobility, also a huge sustainability theme. Food and wellness, somewhere near the bottom. I think agriculture is something that's becoming a lot more meaningful in the sustainability and responsible investing space. Sixth from the bottom there is cannabis. Very curiously, our Cape Town audiences seem to pick that up a little bit swifter than our other geographies. But I'll leave you to have a look at these slides. I think it offers quite a nice insight into where a lot of assets are being flowed at the moment. I did present on the slide, I think, on the same webinar series last year. So this is the World Economic Forum top 10 global risks by severity over the course of the next decade. So climate and environmental ones are receiving a significant amount of attention and probably placing the highest value of risk, or at least risk attachment to them. Climate action failure, extreme weather, biodiversity loss. And then on the social side, which we've seen quite prevalent in South Africa, really starting to surface a lot of that lack of social cohesion. And from the looting to what we're currently seeing in the taxi space here in Cape Town as well, the livelihood crisis as the inequality gap in South Africa becomes even more stretched. And I think that's pretty much a global story as well. Interestingly, infectious disease only at around 6th there. And bear in mind, this was conducted during the throes of COVID as well. So a lot of context there and a lot of precarious balancing act often that takes shape between the environmental and the social. So this just gives you a nice overlay in terms of if you were to engage your fund managers on some ESG issues, this is what global leaders are currently thinking about. So we at Neg Group have are proponents of what my mom would always say was KISS, keep it simple, stupid. So we've highlighted 4 key sustainability focus areas for us for the decade leading into 2030. I've spoken about these a fair amount of previous webinars. So we have climate change and biodiversity loss on the environmental side. And on the social side, we're looking at people, diversity and inclusion, and human and labor rights as well. So it might appear quite simple on the surface, but there's a lot of complexity behind these 4 focus areas. And we are, by our own admission, still figuring it out a lot, but we're trying to make incremental progress and hopefully hold ourselves up to a relatively high standard in terms of our responsible investment efforts. Myself and Amy Jansen, who some of you may be familiar with, she's head of our sort of behavioral sciences division here at Neg Group. We are working on a responsible investment project together. We've been engaging with all our asset managers that we partner with. We conducted a series of interviews with the investment teams of all these managers. I think there was something between 20 and 30 individual interviews that we did, and that was in line with the University of Pennsylvania, the master's students there. And as you can see, this, I think, captures a lot of the complexity that we're dealing with in terms of the pillars of responsibility. And I think none of these responses are all wrong and none of them are all correct either. I think it's a multifaceted approach where everyone needs to be asking the question on responsible investing. So you can just see some of the confusion here where one interviewee said that IFAs, the advisors, should make the first move on responsible investing. Another believes that clients need to ask for responsible investing first. A third person said institutional side of Neg Group investment should make the first move on responsible investing. And interestingly enough, I think in the institutional space, we're probably seeing the most, I guess, I'm not sure if progress is the right word, but a lot of pressure from a regulatory point of view if you see what's written into the Reg 28 of the Pension Fund Act. And the fourth respondent said that asset managers should start the conversation on responsible investing. So we obviously fit into that bottom right bracket, but I believe it will really be a collective effort from all players and agents within this space. So just to finish off, I realize I only was given about 10 minutes or so today. It's really about gauging authenticity from asset managers. So when we speak about, focusing like the economist might recommend purely on climate, I think it ignores some of the effort a lot of our local managers are making, particularly in the social space. So if you are to chat to a manager, I think it's worthy to try get a better sense of what their corporate culture and where their value systems lie. We have a manager that takes quite a strong or passionate stance on gender diversity and gender representation. So if there's not a threshold of 30% female representations on the board, they engage with their company to get above the 30% mark. And I think there's a lot of merit to be placed in some of these little focus areas if you can have a material difference. And I think that speaks to the word authenticity. So we deal with managers which have their own sustainability teams of 5-10 individuals, which obviously takes on quite a different stance when you're chatting to a smaller manager or a boutique that might, just have an investment team of 5 individuals. But again, the merit there is in the detail and the authenticity behind their efforts as well. And it becomes a very different discussion when you're chatting to a small local manager versus, per se, a large international manager. So we have some wonderful stories as we engage with our managers on some of the things that they're focusing on through responsible investing. And we encourage you to engage us further on those, and we're happy to share some of that information with you. This is just a little pocketbook which maybe you take into any manager meetings that you may have of what you can ask them in terms of what they're doing. And I think not to be sneaky, but it's also important to ask them in an unprepared manner to try gauge whether they are sort of bona fide responsible investors with a little time to actually prepare for these type of questions. Not so much to catch them out, but to get them to give an honest reflection and honest feedback on the efforts that they are making. So the first would be, what social, environmental, or corporate social investment initiatives is your business is currently involved in. We believe this represents quite a nice lens into the culture that they operate under and where their values currently lie. Because if you're holding companies up to certain standards, maybe you should hold yourselves up to those similar efforts as well. The second question would be, which investee company management teams have you recently conflicted with on ESG issues, and what were the excuse my English there, what were the contentions? I think recency is very important here. Again, it's just to see how those companies are aligned and whether they actually are engaging with those companies in the first place. We really want to dispel the notion of lip service behind what our asset managers are doing. And then third but not least, I think would be to pick one of their top 5 equity holdings and ask how the company satisfies or meets their ESG conditions. Again, it's significant that the managers maybe not prepared for a question like this, and they should be able to articulate in such a way whether a very significant holding meets their own ESG hurdles, and if so, why? And importantly, if not, what are they doing to engage their company to make sure that they are appeased and at least their company is operating or at least focusing enough on these ESG risks that satisfy you as an investor that is very much aligned with your own responsible investment policy. So I'm going to leave you with those 3 questions to ask your manager. I'm not sure if these slides will be shared with you after today, but that's enough from me, and thanks very much, and over to you, Trevor.
Dave, thanks for that. Very insightful and some great tips for the advisors and wealth planners on the call today. Just 2 questions from myself that have been raised, and I guess touch on some of the points that you've mentioned. When we take ESG as a topic, I guess, and we look at the South African listed companies relative to perhaps their global counterparts listed on offshore stock exchanges, how do they compare? How do the local boys pack up to their global counterparts in terms of taking ESG seriously, the projects that they're doing, implementing it within their businesses and policies, etc. So could you just comment really on how we're doing relative to a global scale?
Yeah, thanks, Trevor. I remember in economics we learned about the NFF, or the net foreign factor, where we believe offshore is often better, but I think our company is actually doing relatively well. I spoke about the rather simplicity of the economist recommendation, but I think locally our companies are dealing with a lot of complexity, both environmental and social, and often it's taken a shock to get them to perform even better. So we had obviously the droughts here in Cape Town. We saw a lot of companies allocate a lot of capital to water efficiency programs. Similarly on the energy front, our companies are doing an incredible amount from self-generation, and maybe that is because of what's happening at Eskom. Anglos, for example, are looking to generate around 3 gigawatts, I think it was, of their own self-generation, which is incredible for a corporate entity. So our businesses are proving quite robust in the ESG space. There's always work to be done, but I think they're doing relatively well. And similarly, on the kind of shock front, obviously the governance failures at Steinhoff has probably made shareholders a little bit more aware of governance risk, and hopefully putting those pressure points on companies that we won't have another Steinhoff in the near term.
Cool. Thanks for that, Dave. And if we just take it perhaps one step further to the regulatory level. Do you foresee the regulator, whether it's, I mean, I think it started to happen a little bit in Europe and within the UCITS fund structures, etc. But in South Africa, within the unit trust environment specifically, perhaps, do you think the regulator's going to start making changes or insisting on companies reporting in certain ways, perhaps the unit trust funds reporting on their fact sheets from an ESG perspective, or listed companies in the annual financial statements having to include certain measures and comments, etc.? How do you see that playing out?
Yeah, so our corporate disclosure in terms of ESG is really, really good in South Africa on things like carbon and water, for example, some of the highest in the world. We currently in the process of doing our SFDR, or Sustainable Finance Disclosure Regulation in Europe, and it is a meaty project, to say the least. So we are proponents for regulation, but and I do foresee it arriving in South Africa. I think there's an inevitability about that. But maybe lighter regulation is better placed, at least from the beginning onwards, as we go through some teething issues. I mean, a lot of the work I did with Amy on the behavioral side shows that almost too much regulation, very strict regulation, almost creates a sense of fear where asset managers are nervous about pushing the ESG efforts because they get called to task on some of these, and we saw that litigation in Europe. So maybe lighter touch regulation will be a good thing initially, because we don't believe that one ESG description fits everybody. But I think it is an inevitability that we're going to start seeing it on our fact sheets. We've introduced it in our quarterly commentaries at a fund level as well. But I guess it's only a good thing as we up our own disclosure in the space.
Dave, thank you so much. And I guess we need to also mention, which I think we've communicated quite well as a business, but that Nedgroup Investments in the last year has become a signatory to the United Nations Principles of Responsible Investing. So that was also, I think, a step in the right direction. Dave, thank you so much. That's really, really helpful and insightful, and appreciate you making the time to join us today.
Absolutely. Thanks for inviting me, Trevor. Take care.